The first thing I'm going to do to start the presentation this afternoon is turn off my cell phone. If you would like to join me in doing that, it would be greatly appreciated. Mine is off. And I'd also like to thank those of you who have bought my books. I've been able to autograph some of them for you. Thank you very much for that. And thank you very much for buying the books. All of the money, my royalties, have gone to scholarships at the University of Oregon School of Journalism to put out more journalists writing bad news about the market so we can buy when the bad news comes out. But we've put them like 21 kids through college thanks to you and the royalties from the book. So we really appreciate that. Thank you. And so do the kids at the University of Oregon. So go Ducks today against Michigan State. They'll be playing tonight. But it's really has been an honor to be able to do that. And I got help when I was in college. I got a little bit of a scholarship, and to be able to give back has been great. We also support a couple scholarships in the Virgin Islands every year, 2 full-ride scholarships there. So it's always great to try to help younger people do things a little bit better. There have a couple questions that came up, so I want to review a little bit of the last part, because really the easy takeaway from this presentation, here's how to make 20% a year in your money without very much work, with working 5 minutes 4 times a year. So I'm going to go over that, then I'll show you a little more complex version for those who want to get really more sophisticated. But with that, Harry, if we can get to the... So what we're going to be doing is real simple screen. We're going to first stack the lowest price stocks, first thing. Secondly, we're going to then buy those 5 lowest price stocks as long as the forward PE is positive. Second thing. That's it. We will roll those stocks every quarter. We'll look 4 times a year and see if these stocks have changed. If they've changed, we would be automatically taking a profit on one that's no longer in that group and buying one that slipped into the group. That's all there is to it. Question? When you roll it, you're doing it at the end of every quarter. At the end of every quarter. So by the first, you're into the new. Right, and sometime in that week, and again, I'll try to buy a little weakness, sell a little strength, all that stuff you're going to do. But by the end of that first week after the quarter, I really should be in those. Otherwise, you'll be chasing the rest of your life, and you won't be following the strategy. Way in the back, please. Options, you know, I don't know enough about options to answer the question. We've just tested buying the stock. So you probably know a lot more about options than I do. The problem with the options is the time, because we're going to hold on to these for maybe a year or more. They could be in that group. Also, when we buy them, we buy equal dollar amounts of each stock, and we do not have stops in the marketplace, so we cannot get a margin call, and we're not paying interest on the margin of money. So it's a cash-only transaction as far as we're concerned. Please.
Basically, we're buying 5-stock portfolio. So basically what I understand is idea is diversification into 5 stocks. Otherwise, we could have picked one also.
Right, we could pick just one, but that might be the bad one. So we want some diversification of blue chips, seasoned stocks that are blue chip stocks with good valuations.
And what about the sector diversification? Let's say out of these 5, if 3 come from, let's say, IT or the tech, you know. So what do we do about that? Do we go ahead and buy it?
We buy them because in our testing, we didn't look at any of that. We just looked at the buying. And since the Dow doesn't have all the Dow stocks or retail, they're all computer, which is probably not going to be much of a problem. They were all in the exact same sector because the Dow itself was spread across a lot of sectors. Excuse me, guys. Yes? I'm sorry, I didn't hear that.
When you rebalance at the beginning of the following quarter, and one of the stocks you keep, and it's gone up, do you rebalance to that value of that stock so that all the stocks are evenly valued? You know, you have an even amount of money in each stock at that time?
The question is, you're revaluing, you've made some money in that stock, now do you spread it out across the other stocks? We haven't been that lucky yet to have that much of a difference. So we're just buying the same amount of money that we had of the stock that we exited, because there's usually not that much difference, maybe 2 or 3 percentage points difference, but nothing of any great consequence. But we will continue trying to keep within that equal dollar amounts. But we've never been that lucky yet to have that big of a win in any one individual stock. Please.
For the back test you performed, what forward PE limits have you used to exit some of the positions?
Zoltan's question is about our exit. Did we use any PE ratios? No, all we did was roll at the end of every 3 months. That was it. And we only looked again at the lowest price stocks that had a positive forward PE. That's all there is to it. That's it. If it's no longer in the 5 group, those 5 low price stocks, we're out of it. I'm sorry?
What limit can we get out from the 5, those stocks?
If we get out of all 5, well, if they've all 5 to move out of that group, we'll be buying 5 more stocks.
I understand, but when you're moving from one stock to the other, there is a criteria. The forward PE has increased, no?
We don't care if the forward P is increased. Again, all we're doing is finding the 5 lowest price stocks. If they have a positive forward P, we're going to buy them.
I have a question.
That's it. Hold on, I'm not certain he's got it yet.
We got that. After 1 quarter, the forward PE value for our portfolio, let's say for one of the stocks, went up to 30.
Great. It's still in the low price stocks. We still hold it.
Up to which limit is this in the?
We still hold it. But the only way that could really happen for that low P to go to 30 is it went up in value a lot. So we'd be getting out of it. But it doesn't matter. Our test again is if it's in the lowest 5 stocks, we hold on to it. If it's gotten out of that and another stock has come in, we exit one, buy the other. That's all there is to it. It's really simple.
So basically, if it goes up, the stock price went up, so it's not going to be in the lowest.
Right. If the PE ratio went up, most likely either they had horrible earnings or the stock went up in value is more likely to happen. So we're still on it, or we've exited with a profit.
Now, what if the PE goes negative in that first?
If the PE goes negative, what are we going to do? We're not in it. We got to kick that one out.
We're going to short it.
Well, he's going to sell it short. But we wanted a system easy enough that a dentist could do without any of this other stuff involved. Please.
You talked about getting in October and out in May. How does that relate to?
Well, that strategy would be the same. You'd buy the stocks about October 19th or somewhere between September and October. And you're going to do the same roll. You could do it the first of the year, the end of the first quarter in March, and then in May, June, you want to go to the sidelines. That's the seasonal approach. You don't have the big equity dips. But because of what I taught you about recessions and market timing, you probably don't need to do that. You probably, oh, we have a recession sell signal, let's just move to the sidelines instead of doing the seasonal, because you really don't do as well. Your average rate of return with the seasonal strategies, from memory, 17%, 16%. With fully invested, it's 20%. Big difference, annualized.
And in that case where you're out because of some fundamental reason, I get a rate of change that says to get back in, and it's February, would you align back with the quarterly, or would you still just do 3 months?
Good question, thank you for that. If I get a 13-week rate of change buy signal, or one of the other buy signals I'm going to show you in a little bit, if I get a buy signal, I'm going to go and do my screen, find my stocks and buy them. And then at the end of the next quarter.
At the quarter, not 3 months?
Right, no, at the end of the quarter. I mean, all my tests are the end of the quarter, so you could do 3 months. You can romance this however you like to, but no. The only thing is, let's say we get a 13-week rate of change and it's March 15th. So I buy the stocks. Am I going to roll at the end of the quarter? No. It's about the end. It probably doesn't change anyway, so just other than that, yeah.
I wanted to ask about the test. When the test was run, when you get out of that stock, that test would simply, for that money, they got out, buy the additional 5th stock, or they would go with 1/5 of the overall value?
It just bought the next stock,
For that
but on an
money, they
equal
got out
basis.
on
Right,
equal
yeah.
basis.
Just one question.
Please.
Similar to this. So let's say, I'm guessing we are looking at 20% of the capital to each stock, okay? So at the end of the rollover, but still the same 5 stocks, but one stock now represents 30% because it increased a lot. The other are like 10, 15. So to rebalance it by sending the 30%?
If it makes a substantial difference, yes, rebalance it. Usually it won't, but if it does, sure, rebalance it. Absolutely. Sometimes it'll be kicking out 2 or 3 stocks. So then you would rebalance, but usually just 1, and there isn't that much of a difference. Okay, now, this is what I'm doing right now in our portfolio. We happen to be long GE, Cisco, Intel, Pfizer, and Coke. Those are the stocks we were bought in the end of the last quarter. When was that?
End of June.
June, end of June, thank you. And they're still in the same group. So we don't have any rollover. What's nice about that? We don't have any brokerage commission, do we? What's bad about that? None of them went up in value. But it doesn't have a high transaction cost because usually the last rollover we kicked 1 out and put 1 in. So it's not a high transaction cost type of in, out, in, out, in, out type of thing. So my work is done really until the end of the year, unless something changes radically in the next 12 trading sessions. And one of those stocks moves up or whatever, then we'll look at it at the end of September. Right now, okay, I'm in the same group of stocks. I'm happy. I'm fully invested in quality stocks, and I think that they'll move higher. And that's all there is to it. Please.
I know you don't have stops on these, but if you had a 20% decline or something to that effect in the stock price in between your adjustment periods, would you do something like that?
No,
Or
I'll
you
just
would
stay
write
with the
that out?
stocks. Yeah. And I have written it out. Okay, that's fine. That happens. And so if they go down, they go down. I just live like this year. They've come down a little bit, right? Well, fine. We're in them. We're with the program. We're with the strategy. What I don't want to do is start trying to get fancy dancy, go here and go there and do this and do that. Then you get off track and you're not following it. And the hardest thing for me has been to follow this because I was frightened of the future until I realized we're in an uptrend. We've been in an uptrend since 1723 when they started trading stocks in America. So it's always going to be long.
I mean, if you ride it out, do you ever sell puts on the stocks you already own?
Do you ever sell puts on stocks you already own? You could do that, I suppose. I looked at it, but the put premium wasn't very much. So I go, well, I'm not going to get premium on this, so why even do that? But sure, you guys and gals can build on this in a lot of ways. I'm an old man. I don't think real well anymore. So you guys, you could probably add things to this, okay? A lot of other room for it. In fact, I'll show you a couple of other ways of trading this strategy now. If you want to get more sophisticated with it, you get a little better performance if you do this. If you look at the price-sale ratio, which we know is an important consideration, and multiply price sales by 10. So that price sale for GE would be 18.1. And add that to the forward PE of 16.1, you'll have a value that puts price forward and price sales comparable. If you do that for the 10 lowest price stocks, and then buy the 5 with the lowest price combined price sales forward PE multiplied by 10, you do a little better than the simple dentist system. A lot more work, a little more confusing, but you can do that. If you want to take it to another step where you're worried, Zamir's saying, well, I don't know, Harry's going to be buying this, I don't want to buy the same stocks he's buying. You want to take it to another step, you could do that. That actually tests out marginally better, like maybe 1 percentage point better. It's an interesting idea though, isn't it? How do we equate PE ratios where the number is 10s, 16s, 14s with price sales where the number is 1 to 2? So automatically PFE with a price sale of 4.2 puts it at like a 42 forward PE ratio. That's a really high price sales ratio. So you generally speaking want low price low price sales ratio. A good way of equating that, multiply it by 10, add it to 12-month forward PE, and now you have the ultimate valuation of a stock in the Dow Jones Industrial Average. But again, our emphasis on the 5 low price stocks. We want to be buying the 5 lowest price of those groups. It's just a little more sophisticated to do it that way. The results won't vary very much. Please. The maximum drawdown, I've never looked, don't care. But we know historically the maximum drawdown in the Dow has been 25, 30%. So could that happen? Yep, sure could.
But the examples that they are running show the maximum drawdown, all of them over 80%.
Some of them will have large drawdown, but we'll have a smaller drawdown than the Dow Jones will have because we're in better stocks. So if I'm a fully invested investor, which I want to be in a long-term program, I'll beat the Dow. On the downside, I won't. Remember, we saw the Dow took out the low like 8, 10 years ago. Our program took it out 2 years ago. We'll have less drawdown and more upside in the Dow.
So this portfolio you have, now we have a little bit of correction, whatever you call it.
Right.
How much is your portfolio is down?
I haven't even looked.
You haven't still-
No, why look? You know, everybody look, oh my gosh, it's up, it's down. I don't care if it's up or it's down. I'm just going to follow the strategy. Otherwise, I'm going to become a short-term trader. I know what, Larry, that maybe you won't do that, but I know what I do. Oh, that's down, I get worried, I do that. So you know what, Larry, I'm in 5 stocks. I'm in 5 great companies. Why start to get worried about it? I have a strategy, I follow the strategy. Otherwise, you'll start to muck up the strategy. I know that because I did that. So I just follow the stupid rules, Larry. But see, that's hard for me to do because I made up the rules. For you, it's easy because you think that they came from heaven above. I know where they really came from. So it's very hard for me to follow my rules. Shouldn't tell you that, I suppose. Laurie?
Just to review, so it's price sales times 10 together, added to the forward PE. That total is what you're comparing and looking for the 5 lowest.
Of that value.
Okay,
Yep. Mhm.
very good.
Yep. So if you want to take it to another step, you can do that. Okay, are we through with all this fundamental valuation? No, one more question.
What's the point of the fully invested? Why do you have to be fully invested?
Why do I want to be fully invested? You mean-
Not why you want to be, why you said you have to be, or should be, I guess.
Well, because I want to catch up or drift.
You're just trying to get the maximum.
Yeah, because I might be wrong in my timing.
And this is where you're going to get in as far as all other markets and so on?
Right. Remember when we all said the trend is up?
Yeah.
I don't want to miss it.
The only one that has drift like that.
Yeah, right. The chances of missing upward drift is real high. So if I'm fully invested, I will get upward drift. At some point, it will drift up. So and I guess part of it just become to me like stocks go up, they go down, but I'm in for the long term, even at my age. So I got at least another 2 years left, so I'm in for a long term here. Hopefully a little more than 2 years. Yeah, absolutely.